Hello, I am Mark Goodwin. I'm the editor-in-chief of Bitcoin Magazine. I am the author of the book, The Bitcoin Dollar, which takes a look at basically the mechanisms of the new financial system that we are in that involves Bitcoin and dollarized tokens.
And what's the deal with stablecoins now?
Well, stablecoins are this funky little thing that they're really a bedrock of the crypto industry, and what they are is just dollar-denominated representations on a ledger, and they are basically just in the same way a normal retail bank would take a treasury from the United States and use that collateral to create a dollar instrument on top in your checkings account, and then they use them to issue dollar-denominated tokens on blockchains.
A lot of people are concerned now about CBDCs. What have you observed the plan is?
I would say within the United States, a directly issued government central bank digital currency is a total red herring, and they're going to do what they always do, which is hide behind the private market and the private sector and have private capital creation through private banks continue this racket. And the main thing that people sort of are scared about with CBDCs is surveillance and programmability, and all of your data and transactions being at the whim of big government and big brother. Well, they're recreating that exact same mechanism, except instead of the public sector, it's private banks, and it's JP Morgan, and it's Cantor Fitzgerald. This is not an improvement in any way. The private sector actually retains a lot more rights to restrict customer access than the public sector would. So they're going to do what they always do, and use the private sector to create a completely surveillable, completely programmable digital dollar. And we will see this fight against CBDCs by the likes of DeSantis and Trump and Vivek. And there'll be this total red herring false victory as then they move into the private stablecoin system that in every single way is the CBDC, except it's not issued directly by the government. Stablecoins are the bait and switch for direct issued government CBDCs.
So CBDCs, what do you think, UK and US, we won't see it?
Obviously we have seen CBDCs in certain areas, the E1 and, there's the eNIRA, and there's these interoperable sort of direct issued tokens that do exist. But in terms of the only real huge foreign exchange currency that really matters, it's the US dollar system. There's no way we're going to see a direct issued digital dollar from the United States government. There's some legal reasons for sure, but there's also technical. I mean, it's a huge technical debt to create technology like this. There's a lot of manpower, a lot of resources. And yes, as I said, there are some legal issues, of course, as well. But for the most part, I think it's because the public sector likes to hide behind the private, and it likes to use these highly regulated, highly controlled, private, really in name only companies to basically do the innovation that the public sector needs. And I also think it's interesting too that this is how the dollar system has always worked. The dollar has been digital for a very long time. This idea that the dollar is only now going digital is just incorrect. It's been digital for at least 20 years. The checking account integer that you have when you go on your Bank of America app, it's a digital dollar. And the way that digital dollar works is it's backed by a treasury that's held at some custodian. That's exactly how stablecoins work. It's the exact same mechanism. It's just instead of it being this, SQL database, it's a decentralized database on Ethereum, or even sometimes they're using Bitcoin or some of these other chains. But it's the exact same mechanism. It perpetuates the exact same system, the US dollar system, the treasury system. And these stablecoin providers are really just continuing US dollar, economic hegemony throughout the world. If you are a government entity coming from the public sector, there's actually restrictions on what you can restrict. There's a lot more red tape about what you can actually deny access to. If you're a public, sector entity, you have to be very inclusive. If you're a citizen, you have to have, certain rights to be able to access it. The private sector, that's not true. The private sector reserves the right to refuse service to anyone. It's like a sign you see in a restaurant, right? And so they want that. That's very helpful for the private sector. They want to blacklist someone. They want to seize your money. prevent a transaction from going through. It's much easier to do that through a private sector entity than it is through the public sector. So much like we saw with COVID, where they used private sector and name-only companies like a Facebook or a Twitter or a YouTube or a Google algorithm, they're able to manipulate what information gets out. They're able to silence voices, all stuff that would be totally First Amendment violations if done by the public sector, but done by the private, it's totally within their right as a private company to restrict speech. The private-public sector relationship during COVID is totally the blueprint for how CBDCs will be rolled out. And that is to say that they won't be directly government issued. They will be a whole conglomerate and aggregate of interoperable private sector banking coins, highly regulated, that are controlled by the public sector in many ways, but actually carried out and issued and settled via the private sector.
How does that work?
How does that work? Well, it works just like how private capital has worked today and has worked for 50 years or more. A private sector bank buys a treasury, a security, a T-bill, a bond from the treasury, and takes that and uses it as collateral to issue dollars. It's the same thing that they've done for, since the gold window closed and since we moved into this treasury-only system. It's exactly what they do. It's just instead of the dollar being issued in some closed, walled database at Bank of America or Wells Fargo, it's going to be on some blockchain.
So what is FedNow?
There's a lot of misunderstanding, and I think on purpose, misdirection and confusion about how a digital Federal Reserve System will work. We saw the rollout of FedNow last year, and there was a lot of confusion of, is this a CBDC? Is there a token? Is this a blockchain thing? Like, what is this? And it's none of those things. All it is an interbank settlement network. It's a way for banks to trade securities between banks. It's a way for the Federal Reserve to pick and choose who gets to be in the Federal Reserve System and give them 365, 24/7 control over the funding rate of money. So you lend money to someone, you want to do this reverse repo trade where you hand over securities to get cash because you need cash now. The Fed now has this system where they are able to oversee all of the settlement of securities within the United States, and they're bringing back the federal funding rate, the overnight funding rate, back from this European Eurodollar craziness in London with the LIBOR overnight rate, and they're bringing it back. They're onshoring the dollar system, and they're basically creating this security settlement network. There's no token, there's no digital dollar, being directly issued. None of that is coming directly from the government. It's just a way for banks to settle debts and securities between each other. This, of course, matters a lot with private capital, because private capital creation all comes downstream of buying securities and settling securities. So FedNow is just a new fancy system. Basically, we were using, FedWire that was like a fax machine. It was very slow. The settlement was bad. There was no, actual settlement of securities between the two parties. It was very, very, very antiquated, like from the 70s technology. And now it's a little more updated. Things settle faster, and they're able to set these overnight funding rates, at a click of a button from an office, in the Federal Reserve System. FedNow has nothing to do with what is the talked about CBDC thing of this direct issued, programmable, highly surveilled thing. But what it's more telling as to actually how the reserve system of the U.S. dollar works. The U.S. dollar is not the reserve asset of the world. It's the currency, but the reserve asset is the securities, the treasuries that are behind the dollars. That's really the reserve asset of the world. It's these treasuries. And FedNow just creates a better system for Fed-based control over the settlement of securities within the United States. The big fear is, this Black Mirror-esque kind of spooky world where you open up your cell phone and, you scan your iris and you get a Fed coin, UBI, direct deposit into, that's kind of the spooky world that they've painted. That's the picture that we're all expecting that the future is going to be. And they're creating this to basically manufacture consent so that when they defeat this red herring CBDC and replace it with the private sector, that we all feel that this is a win. Oh, this is so great. It's not a direct issue. The government, those nasty, evil government guys aren't controlling my money. Instead, it's just Jamie Dimon and Howie Lutnick. And it's these guys that, run USDC and run Tether. And, these guys aren't these really bad government baddies. Like, this is fine. It's the private sector. And obviously that's, it's a false victory. And so we're seeing an establishment of a new system that uses these tokenized dollars to really increase the velocity of the dollar and increase the reach of the dollar at a global scale. By digitizing the dollar, we can spread it all across the global south, all across Asia, all across Africa, and we increase the demand for treasuries that back these stablecoins. So when the US government wants to service their debt, they can sell trillions of dollars of securities to these stablecoin issuers that have so much demand for dollar instruments across the world that they'll be able to offset and service the US government's budget by selling these treasuries to stablecoin providers. This is something we've already seen. Tether is about to cross $100 billion worth of treasuries held, most of it at Cantor Fitzgerald. This is an extreme amount of treasuries. If they were a nation state, they would be in the top 15 nation states in the world of treasuries. I mean, you look at China and Japan, which are the two biggest treasury holders, debt holders of the United States, and they're at just about $1 trillion. So it's like 1/10 of China and Japan is held by one private company that's a stablecoin issuer, and the stablecoin market is still a very young market. I mean, the stablecoin market is under $200 billion. That's nothing in the grand scheme of things. That market is going to go to trillions and trillions of dollars. We have people on record like Walter Hessert, who's the head of strategy for Paxos, which does the PayPal stablecoin. And he has said verbatim to my face, I do not see any world where we do not have a stablecoin market of being in the trillions, of highly regulated stablecoins. It's going to be trillions of dollar market, easily. There's a whole bunch of ways that stablecoins can be programmed exactly like how we fear CBDCs will be programmed. They're exactly the same tokenized mechanism. They can be used in smart contracts. They can be used to collateralize loans or mortgages. They can be backed by certain things. They can be taken out of your wallet. Your wallet can be blacklisted. A lot of the things that we fear about CBDCs are totally available within the tool set of stablecoins. In fact, we've actually recently seen Tether, which is the biggest stablecoin issuer in the world. They've actually onboarded the Secret Service and the FBI directly to their system to be able to look for launderers and to be able to blacklist, criminals. And again, this is not this freedom technology, this financial tool that people claim that it is. This is a control system. The dollar is used to manipulate, asset prices, energy prices, the price of labor all across the world. And now we're getting a programmable private market version of this same mechanism, and we're onboarding the FBI and the DOJ directly to the system. It's a very, very dangerous precedent that we're starting, and while everyone is afraid of CBDCs, they're missing the stablecoin monster that's being built right in front of them. Programmable money is, the future of finance. I mean, that's really what they're aiming for, is to be able to regulate without having to have huge amounts of labor. Running a bank is very expensive in terms of how many people, how many branches, keeping the lights on, having people running through all the books, picking up phone calls and handling, service claims. There's a huge amount of profitability that can come from programmability. And that's what this is all about. This has always been about profits and reducing the human capital needed to uphold a financial system. The main issue with programmable money, of course, is yes, there's a third-party arbiter, and you can say that there's a much less ability for failure of settlement to happen. But really what they're doing is having more control over who can buy, who can sell, who can save. And if they want at any point, they can use those programs and the protocols and the blockchains to blacklist your money, to prevent you from making a transaction, and to prevent you from accessing your wealth that you've saved in these tokens.
So turn all money into credits at the company store?
100%. Yeah, stable coins are, I mean, the dollar is a debt-based system. When you hold dollars, you're holding debt. Stable coins are exactly the same thing. So private entity stable coins have been used, within, when you want to short something or long something, whenever you're using leverage to, speculate and basically create price discovery within a new market, which has happened in, obviously in Bitcoin. It's this very digital, new novel financial system that's entirely online. Stable coins like Tether, quite literally called Tether, have been used to influence the price of Bitcoin by creating mechanisms for people to either short or long the price of Bitcoin. We saw this, one of the biggest issuers of Tether was Alameda Research, which was one of the trading desks associated with Sam Bankman-Fried. Obviously, a big part of the FTX, collapse was a play that they were doing using Tether. And they've said this in court. Caroline Ellison said this, that they were using Tether to try to manipulate the price of Bitcoin down. And they were shorting the price of Bitcoin, trying to keep it below $20,000. This was a play that you could see, that's sort of the beauty of blockchain in a strange way. It's a transparency technology. And you can see the inflows and the outflows of these desks, of these issuances. And you could see how Tether had a direct correlation to the price of Bitcoin. When tethers are printed, when stable coins are printed, the price of Bitcoin goes up. It's not exactly one-to-one, but it's really, really, really close.
So what are the mechanics of that?
The mechanics of it basically is that these stablecoin issuers are heavily connected to trading pairs of Bitcoin. So on a lot of exchanges, a lot of people don't have access to US dollar bank accounts, but they want to trade Bitcoin. So the first thing they do is they take their local currency and they'll actually convert it into USDT, which is the Tether ticker. And they'll actually buy tethers and then use that because the dollar-denominated trading pairs against Bitcoin, BTC/USD, BTC/USDT, are much higher volume, and there's much more liquidity, much more open positions in the US-denominated trading pairs for Bitcoin. It's very, very similar to the mechanism that the US set up in the 70s after a really high inflationary period after the gold window was shut. They moved into the Middle East and cut these deals with Saudi Arabia to basically monopolize the in and out of the petrodollar, of the petrol system, and create the petrodollar system. The US government has essentially done that through private entities, through stable coins, and they've created an in and out monopoly on the exchange rate and the exchange of Bitcoin. If you want to buy Bitcoin, you have to get dollars. If you want to sell Bitcoin, you get dollars. They've created this synergistic, mutualistic, potentially parasitic relationship between stablecoins and Bitcoin. Very specifically, we've seen Trump come out and speak against CBDCs and say that he would never issue one. Very interestingly, during his administration, there's actually an email from Jared Kushner to Steve Mnuchin, then Secretary Treasurer, which brings up this Sam Altman of OpenAI blog post talking about creating a coin called US dollar coin, or USDC, and how one could create a stable token related to dollar denominated assets, and how that would actually be really helpful for the dollar system. This was something that Kushner in the cabinet, in the White House, was openly talking about and emailing with the Secretary of the Treasury, Mnuchin. The rhetoric of Trump being this anti-Bitcoin, anti-crypto, anti-CBDC candidate is just that. It's rhetoric. He put in Brian Brooks, who was the former VP of Coinbase, the head legal at the founding of Coinbase, as the OCC, which is basically the head legal lawyer in the United States. And he made it legal for banks to hold crypto assets, to hold Bitcoin, and to issue and hold stable coins. So Trump, while tweeting out that the Bitcoin is against the dollar and he hates it, was actively within his cabinet emailing the Secretary of Treasury about issuing a stable coin, while also putting in people that worked at Coinbase to basically make it legal for the private sector to hold crypto assets. So while we're seeing, populist candidates like Trump and Ron DeSantis coming out, and even DeSantis himself signed a law that's saying that there would be no direct issued currency from the state of Florida. While they're coming out with all this anti-CBDC rhetoric, here comes the private sector with 100 billion plus of highly regulated stablecoins that are fulfilling the exact same market need as a CBDC would, with the programmability, with the surveillance, with the ability to blacklist and to seize assets. All of these things are completely capable to be done on private issued stablecoins, just as we fear they could be on a CBDC system. So obviously the US dollar system is slightly different than a lot of other central banks, right? So we have the reserve currency. We have a completely different relationship with our money issuance than most other central banks around the world. What we're going to see from other central banks around the world is not a retail-facing digital currency, but we're going to see wholesale deposit tokens. We're going to see a digitization of the securities that back currency creation. And we're going to see all of these interoperable systems set up that use blockchain to create digital securities that they can then fractionalize and trade, collateralize and trade and settle between nations instantly. We're going to see these systems be made by the private sector and making deals with as many public sector governments around the world. It's not going to be this one panopticon, one currency, we all use FedCoin and everyone uses the same currency. We're going to see all local currencies, all different types of stable coins and different peg things, and there'll be thousands or hundreds of currencies, but they'll be backed by these assets that are interoperable between all of these systems that are ultimately backed by treasuries that are created by the dollar system. That is what the dollar system wants. It wants to be the reserve asset of the world and remain the reserve asset of the world. And they will create wholesale CBDC deposit tokens, not retail-facing currencies, to achieve that goal. We're seeing a worrying trend of the largest American banks moving into the Bitcoin and blockchain space, including JP Morgan, Wells Fargo, Bank of America. They're here. They're going to issue stable coins to their retail-facing customers. I think one of the most worrying things about discourse in the Bitcoin space in regards to its use as a currency is that one of the big scaling models, the way that Bitcoin will be globalized and be able to service billions of people, is by using stable coins and actually not by giving access to Bitcoin itself as a currency. We're seeing a lot of money going into the space, venture capital, to create dollar tokens on Bitcoin and on Lightning, rather than any sort of sharing model where the currency of Bitcoin is actually distributed amongst people. There's a huge financial incentive to not talk about the elephant in the room of stablecoins within the Bitcoin space, both in how stablecoins affect the price of Bitcoin and also the scaling mechanisms and how Bitcoin could service billions of people. One of the most important metrics in the US dollar system is the interest rate, basically the funding rate, the cost of borrowing money. In the future, in a stablecoin sort of based algorithmic economy, we're going to see an algorithmic yield of how much, when you leave your stable coins in an account, how much you actually, what you would normally call an interest rate in your savings account. When we were younger, we used to get, a few percent in a savings account. Now it's 0.5% or less. What we're going to see now is an algorithmic yield in a private issued stable coin account. So rather than the growth of money in your account being based on the federal funding rate set by Fed governors, instead it will be a computer program that algorithmically programs the interest gained in your account. If you look at the similarities between a CBDC system and a digital dollar from the private sector system, the prerequisite for both is some form of digital identity. A decentralized identity or a digital QSIP, some sort of identification number that exists. Either way, if it's a direct issued government CBDC or this private sector stablecoin, you have to have some way of identifying yourself to interact with the system. A prerequisite for either of these things is a digital ID. And when you look at what these people are actually saying, these big guys, these big four American bankers, the World Bank, Davos, World Economic Forum, Bill Gates, the Rockefeller Foundation, JP Morgan, BlackRock, a lot of these entities are directly putting funds towards development of all different types of digital IDs.